Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Crawford & Company Annual Report. Crawford & Company offers a wide range of businesses and services to its clients across various regions. At the core of their offerings are claims management solutions, which include adjusting services for property and casualty insurance companies, field investigation, and evaluation and resolution of property and casualty insurance claims. The company also provides specialized services such as workers' compensation, liability and property claims management, as well as death and dismemberment, business travel, life, disability, critical illness and credit protection claims programs. Additionally, they offer legal services, risk management information, and consultative analytical services to help clients mitigate losses. Crawford & Company services also extend to loss mitigation, including medical bill review, medical case management, and vocational rehabilitation. They provide administration of loss funds established to pay claims, as well as managed repair service and outsourced contractor management for national and regional personal and commercial insurance carriers. Furthermore, the company offers staff augmentation with temporary staffing resources and outsourced subrogation, claims management, recovery, and consultative services for the property and casualty insurance industry. They also provide services on losses caused by natural disasters such as fires, hailstorms, hurricanes, earthquakes, floods, as well as man-made disasters like oil spills, chemical releases, and explosions. Overall, Crawford & Company's diverse range of businesses and services enables them to cater to the complex needs of their clients across various regions. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what might cause a stock price to drop. The stock price of any company can fluctuate due to various market and economic factors. One possible reason for a decline in stock price is poor financial performance, such as declining revenue or profits. This can be caused by internal issues like inefficient management, lack of innovation, or external factors like changes in consumer demand or industry trends. Another factor that can contribute to a drop in stock price is negative news and publicity surrounding the company. This can include scandals, product recalls, or other controversies that damage the company's reputation and erode investor confidence. Additionally, market conditions such as economic downturns, interest rate changes, or shifts in investor sentiment can also impact a company's stock price. If investors become risk-averse during times of uncertainty, they may sell their shares, causing the stock price to drop. Lastly, regulatory issues or legal problems can also negatively affect a company's stock price. This can include noncompliance with laws and regulations, fines, or lawsuits that damage the company's reputation and financial stability. In conclusion, there are several factors that can contribute to a decline in a company's stock price. These include poor financial performance, negative news and publicity, market conditions, and regulatory issues. Crawford & Company maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Crawford & Company trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 3.05 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.78%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of various segments, geographic regions, and service lines. In terms of segment performance, the International Operations segment experienced a significant 26.8% growth in revenues before reimbursements, while the Platform Solutions segment saw a 10.9% decline. Geographically, the U.S. market showed substantial growth of 362%, whereas the UK market declined by 14%. The Canadian market remained relatively stable, with $89 million in revenues for 2025. Within service lines, claims management and medical management demonstrated growth, while contractor connection experienced a minor decline of 1.3%. The drivers of revenue growth or decline can be attributed to unbilled revenues, which increased from $5.78 million in 2024 to $9.9 million in 2025. The changes in fair value of contingent consideration also had an impact on sales and general administrative expenses, resulting in a net increase of $490,000. Overall, these factors contribute to the company's revenue growth or decline across different segments and regions. The net income of the company experienced significant fluctuations between 2024 and 2025. While it initially decreased by $7 million, subsequent changes due to foreign currency exchange rates resulted in an increase of approximately $3.3 million. However, overall, net income declined by 25.8% during this period. On a more positive note, the company's net income increased compared to 2023 and 2022. Profit margins also underwent changes, with a decrease of 2.1 percentage points from 2024 to 2025. Nevertheless, certain segments showed improvements, such as the International Operations segment, where gross profit margin increased by 2.7% and operating margin rose by 2.1%. These variations in net income and profit margins can be attributed to several factors, including fluctuations in catastrophe-related work, restructuring costs, changes in valuation allowances, and performance in foreign jurisdictions. Additionally, inflation poses a potential threat to profitability if labor and operating costs cannot be passed on to customers. The company's financial performance is a notable aspect of its overall health. One key indicator of this is its ability to generate positive operating cash flow. According to the provided data, the company has consistently demonstrated this capability over the past few years. In 2025, the company generated $101.8 million in operating cash flow, showcasing a significant increase from previous years. This trend is also evident in 2024, where the company produced $51.6 million in operating cash flow. Furthermore, in 2023, the company's operating cash flow reached $103,790. The consistency of positive operating cash flow across these years suggests that the company has a stable financial foundation. This is a crucial aspect for any business, as it enables them to invest in growth initiatives, pay off debts, and maintain liquidity. The data from page 43 and page 59 provides clear evidence of this trend, dispelling any doubts about the company's ability to generate positive operating cash flow. The company's debt level has undergone significant changes over the past few years. While total long-term debt and finance leases decreased from $218,137 in 2024 to $150,593 in 2025, other areas saw an increase. Short-term borrowings rose by 119% from $17,822 to $38,500, and the credit facility outstanding amount increased from $217,979 to $189,000. The overall debt level has risen to $189.1 million at December 31, 2025. In contrast, interest expenses have generally decreased over the same period. Interest expenses dropped by 15.8% from 2023 to 2025, and net corporate interest expense decreased by $2.3 million from 2024 to 2025. While there were some fluctuations in specific years, overall interest expenses have trended downward. The financial performance of various segments and regions has been mixed, with some areas performing exceptionally well while others struggled. In terms of regions, the US, Europe, Asia, and Latin America all showed significant revenue increases, ranging from 2.6% to 24.2%. These regions were driven by strong demand for services and a favorable business environment. In contrast, International operations, Australia and Canada performed poorly due to various challenges such as political risks, exchange rate fluctuations, and reduced weather-related activity. International operations faced significant risks that impacted revenue, while Australia experienced a decline in revenue due to the disposal of its legal services business. Among segments, Broadspire stood out with a 3.6% increase in revenue and reimbursed expenses, increasing to $3.5 million. The North America loss adjusting segment also showed improvement, with a revenue increase of 2.8%. However, other segments such as Platform Solutions, Network Service Line, and Contractor Connection Service Line struggled, with declines in operating earnings, gross profit, and case volumes. Overall, the performance of various regions and segments highlights the importance of adapting to changing market conditions and addressing specific challenges to achieve success. Management's outlook on the company is cautiously optimistic. Despite facing potential cyberattacks and increasing complexity in cross-border data transfers, management believes that its current financial resources will be sufficient to maintain current operations for the next 12 months. The company is investing in technology and has reduced costs by streamlining certain areas of its workforce. To mitigate future risks, management plans to make discretionary contributions to the pension plan, aiming to reach fully funded status. Additionally, the company is focused on improving staff utilization and reducing indirect support costs to increase operating earnings. Management expects to remain in compliance with all required covenants throughout 2026 and aims to close approximately 99% of all cases referred to them within 5 years. Overall, management's strategy appears to be centered around cost reduction, investment in technology, and proactive risk management. By making strategic investments and adjustments, the company is positioning itself for long-term success while navigating potential challenges in the short term. The company has a history of rewarding its shareholders through various means. One such way is by paying dividends, which is evident from the numerous references to dividend payments throughout the document. The company's commitment to returning value to its investors is further demonstrated by its share buyback program, where it has repurchased shares on multiple occasions. In conclusion, the company has a proven track record of paying dividends and buying back shares, indicating a strong focus on shareholder value creation. There are currently no concerns regarding inventory buildup or supply chain disruption. According to the provided information, this issue has been thoroughly assessed and deemed non-existent. The absence of any worries in this regard is a positive indicator for businesses and organizations involved in logistics and distribution. That concludes the financial summary for Crawford & Company. Feel free to comment below, and I will be happy to answer them when possible.